All right, let's dive right into this. Welcome back, focused learners, to episode 7 of our 8-part explainer series. This is the Scenario Playbook, Part 2. Now, if you're here, you already know the drill. We don't trade on hope, and we certainly don't trade on hunches. We trade the machine on the other side of the tape. We are constantly looking for the forced, highly predictable flows of options dealers. So today, we're cutting straight through the noise and unpacking scenarios 6 through 10 of our playbook. We're going direct, numbers first, teacher to trader, no fluff. Let's get to work.
Here's exactly what's on the agenda for today. First, the post-OPEX Unclench. Second, the 0DTE intraday whipsaw. Third, the earnings IV crush. Fourth, genuine opening call buying. And finally, number 5, the wall that wasn't.
Starting with Scenario 6, the post-OPEX Unclench. The stabilizer vanishes.
Okay, so here's the exact mechanical sequence you're going to see play out on the tape. Step 1, you've suffered through weeks of this agonizing, tightening pinned range heading into monthly OPEX Friday, right? The market just feels glued. Then, Step 2 happens. Expiration passes. The giant open interest at those specific pin strikes simply expires, and all that dealer gamma attached to it, it completely vanishes over the weekend. That massive stabilizing force is just gone. Which leads us to Step 3. Monday and Tuesday morning roll around, and the market breaks out, and I mean often violently. You absolutely must treat these first 2 sessions after monthly OPEX strictly as a breakout window. The underlying physics of the market have fundamentally changed from dampened to free-floating.
Now, what's really interesting here is the stark contrast in how amateurs versus professionals process this exact same move. Look at the retail trap. They see this violent Monday breakout, they start panicking, and they instantly try to attach some sort of news narrative to it. They're sitting there thinking, oh, the market has fundamentally decided something new today. But the mechanical reality, it's just uncorked pressure. It's like taking the lid off a pressure cooker. Whatever underlying supply and demand imbalance that pinning was suppressing all month long is finally allowed to express itself. Trade the breakout window for sure, but whatever you do, do not marry a fake narrative.
Moving right along to Scenario 7, the 0DTE intraday whipsaw, the round strike magnet. Picture this setup. It's 2:30 p.m. The tape shows the index absolutely glued to a massive round 100 multiple strike, and it's been sitting there all afternoon. Then, seemingly out of nowhere, you get these sudden 30-point air pockets, immediately followed by instant, violent reversals right back through that exact same level. So what on earth is happening? Well, as the close approaches, the at-the-money gamma for 0 days to expiry options just goes vertical. The hedge flows around the specific strike become completely spastic and erratic. So how exactly do we trade this chaos? Here is your strict checklist. Memorize this. First, you have to understand this is an intraday phenomenon only. That flow dies right at 4 p.m. Now, while the pin is actually intact, you can fade those small deviations back to the strike. But, and this is a big but, when we enter the final 90 minutes of the session, just stand aside. The gamma gets way too unstable. Crucially, do not ever set your swing stops just beyond a big 0DTE strike. Those mechanical whipsaws will hunt them down and take you out. Finally, your invalidation point. If you see a decisive late-day break with genuine follow-through away from the strike, stop fading it immediately. It means local gamma just flipped short or one side entirely gave up.
The trap here is absolutely devastating if you fall for it. Amateur traders will see this terrifying plunge at, say, 3:30 p.m., scream institutional distribution, and aggressively short the market, deciding to actually carry that massive risk overnight. Listen to me, this is a fatal error. The entire option structure that forced that afternoon plunge completely evaporates at the 4 p.m. close. Gone. By tomorrow morning, the slate is wiped clean. Holding overnight shorts based purely on late-day 0DTE mechanics is an incredibly dangerous game.
Next up, Scenario 8, the earnings IV crush, the price of the storm. Let's ground this one in some hard numbers. Imagine, right before an earnings event, front expiry implied volatility is totally pumped up to 90%. The options market is explicitly pricing in a massive 8% implied move. The company reports, and the very next morning, the stock actually gaps up a solid 5%. Sounds great, right? But what actually happens to your calls? IV immediately collapses from 90% all the way down to 40% because that pre-earnings uncertainty is totally gone. So even though the stock actually moved in your direction, the vega loss completely overwhelms your delta gain. Your call value just collapses. You essentially bought a 5% move, but you paid for an 8% hurricane. We have all seen this exact quote plastered on trading forums. The stock moved my way and I still lost. Options are rigged. Guys, this is the ultimate retail trap. The market isn't rigged. You just didn't understand the pricing model. You vastly overpaid for Vega right at its absolute annual high. The market literally charged you for the volatility in advance, and you footed the bill. So let's clearly lay out the actionable treatments for this. The bad reaction? Buying naked short-dated options heading into earnings. You are basically setting your money on fire. The pro reaction, though? You have a few smart tactical choices. If you really want to trade direction, just wait. Trade the post-crush cheap options the morning after, or use deep in the money options to minimize that extrinsic value. Now, if you want to trade the volatility itself, you sell defined risk pre-event to actually capture that crush. And remember, the invalidation for premium sellers is super strict. If the gap actually exceeds the implied move, you take the defined loss. Take it immediately. Do not sit there and blindly hope it comes back.
Moving to scenario 9, genuine opening call buying, finding the footprints.
Okay, here is what undeniable, urgent, directional, institutional conviction looks like mathematically. Bar 1 is your baseline. That's your existing open interest. Bar 2 is your alert. Today's volume is suddenly 3 to 4 times that existing open interest. But Bar 3? That is the smoking gun. The very next morning, the open interest has mathematically confirmed that volume. It wasn't just someone closing out a trade, it was massive, fresh positioning being put on the board.
But hold on, before you go blindly following some scanner on Twitter, you have to run this rapid-fire checklist. Look, 90% of unusual options activity feeds are just pure noise. They're hedges, they're rolls, or they're spreads. For it to be the real deal, you need volume 3 to 4 times the open interest at an out-of-the-money strike. You generally want it 6 to 8 weeks out, giving the actual trade time to play out. You need to see sweeps. These are urgent orders, literally smashing through the offers across multiple exchanges. You want to see rising implied volatility all session long, and this is absolutely critical. There can be no earnings or scheduled binary events inside that expiry. Finally, there can be no matching size at another strike, because if there is, it just means it's a spread and not a naked directional bet.
When you finally filter everything down to that remaining 10%, you've got a legitimate tell. The mechanics here dictate that the dealer is now short those calls, and as the stock rises toward that strike, the dealer is mathematically forced to buy stock to hedge, which just adds mechanical fuel to the rally. So trade it within your own risk framework. But you must respect the invalidation. Track that open interest every single day. If that open interest suddenly unwinds, it means the whale has left the building and you need to exit immediately.
Finally, scenario 10. The wall that wasn't. When GGX fails.
We have all seen this happen. Your map shows this massive gamma support level, right? But then price just slices through it like hot butter. Why does this happen? Well, detail number 1, stale gamma. The open interest was actually concentrated in a far off or already rolled expiry. 2, a completely wrong assumption. The model assumed dealers were long, but they actually weren't, so that expected buy flow never existed in the first place. 3, the wall was aggregated across multiple expiries, completely exaggerating its actual size for today's specific session. Or 4, and honestly this is the most dangerous one, the market is in a negative gamma regime. In those volatile environments, those big strikes are trapdoors, guys. They are not floors.
The biggest trap here is treating your gamma exposure map as absolute unbreakable physics. The reality is that the map is just a probabilistic estimate built on assumptions. When a supposed wall breaks cleanly, you need to treat that as absolutely crucial flow information. It's screaming at you that the map's assumption was wrong, and the mechanical, forced flow is actually pointing the exact opposite way. You need to flip your bias or flatten your position. Do not sit there and argue with the tape.
Which really brings us to the core philosophy of this entire explainer. Dealers are forced mechanisms for sure, but price action is always the ultimate truth. If every single options level is, at the end of the day, just a hypothesis waiting for the tape's verdict, are you trading the map or are you actually trading the market? I want you to really think about that before your next entry. All right, that's it for this one. I'll see you in the next explainer.